All right, we are here live with the man himself, JP Conklin, interest rate king. Usually you'd be here in Dallas with us, but I figured we get the latest and greatest from you. So as we're waiting for people to come on, obviously the Fed had their meeting yesterday, and the same way that the Fed gets what, probably a 10-minute opening statement, opening remarks. I'll just leave the floor to you. Um, Give us sort of just like your commentary, first sort of take here May 4th, right after the meeting.
Well, if you're going to give the floor to me for 10 minutes, I'm going to use 9 of them to talk about how the Eagles are better than the Cowboys. So you can tell
Start
me if
right
that's how
there.
we want to spend the time. Yeah, so yesterday was a huge meeting. There was a lot riding on it because the question was, would they start to signal a pause, or would they say, hey, there's still more work to be done. We're very focused on inflation and we need to keep hiking. Um, the statement comes out at 2 o'clock Eastern, followed by a press conference at 2:30. The statement came out and it removed the sentence that said we expect there will be a need for additional policy tightening. So that was the huge news that broke sort of between 2 and 2:30 when Powell started talking. So that right there was the first signal that, hey, they might be done at this point. Um, Powell then came out and gave his press conference. And even though he said things like, a decision has not been made about whether we're going to pause, he kind of danced around whether or not there was much chatter, discussion around whether or not they would pause. Um, he sent all sorts of signals that implied the Fed is done unless inflation starts reversing course over the next couple months. And part of the reason that I think that's my takeaway is because inflation has been very stubborn over the last year. And so I don't think he would have been this dovish and be entirely contingent upon inflation improving a ton over the next 6 weeks in order for them to not hike again. I think he would have said, no, we're not seeing the sort of improvement we need. We need to keep going. So the fact that he was this dovish, knowing that inflation is not improving rapidly, tells me he's already got that baked in. And the bar to hike on June 14th is actually pretty darn high. Um, one of the things that he said that really stuck out at me was if you go back and look at the Fed's forecast from the last meeting, because they only update their forecast every other meeting, he said, we are now at the level that most FOMC members project will be the level that we are at year end. Like he went out of his way to call attention to that. So again, it felt like a really strong message that this is it unless inflation gets worse from here. He did say, listen, there's still work to be done on inflation, but I think the message he's trying to say there is we're done hiking, but that doesn't mean we're going to start cutting. We're now going to start focusing on keeping rates elevated for an extended period of time, at least through year end, in order to really tamper down inflation. But that doesn't mean we're going to start cutting. That cuts are not on the table. We might be done hiking, but we're not going to start cutting. Um, and the market reaction was rates down across the curve. The June 14th meeting, as we record this, has a 0% probability of a hike priced in, which is the first time in about 18 months that we've had no probability of a hike priced in. There's actually a 95% probability of a pause and a 5% probability of a cut right now. The September 20th meeting has a 75% probability of a cut.
So
And
so
then
when you're looking at probabilities, is this what you're looking at typically? This is the CME Fed Watch
yeah,
tool. I don't know, for us laymen out
same
there.
thing. Yep,
Okay.
same thing. Um, and so the one that really jumps out at me is year end, 0.2% probability that they have not yet cut, right? So
Really? Okay.
this is where there's a lot of disparity between the Fed and the market right now, especially over the next 18 months. The Fed is saying we're going to be on hold through year end, then we will probably cut about 1% next year, maybe 75 basis points. The market says no way, that you're going to be cutting before year end and you're going to cut even more next year. You're going to be down at 3% by the end of next year. And so what's interesting to me is if you go all the way out to 2025, the market and the Fed are kind of in agreement. They're not that far off. It's sort of like that 3-ish% range.
Okay.
Market's a little lower, Fed's a little higher. It's the path to get there. The Fed says slow and steady. We're working our way down over the next couple of years. The market says nope, it's going to be slash and burn. 2024, we're going to experience much lower rates. Then you'll be level in 2025 as opposed to still cutting in 2025. So overall, probably pretty good news for most of us in this business. Is just need some relief, need some clarity around when is the tightening cycle done. We're basically there. I think we're done. I think there is some chance that they hike again, but only if the inflation data between now and June 14th shows a reversal in course.
Okay, so I had never I I was getting ready for this interview, and so I watched the 50-minute press conference yesterday, and I don't know how many times he said, we've already gone 5%,
Yeah,
like, that should be enough." Like, I felt like he was just sort of tired of hiking,
yeah.
to some extent. Um, but okay, so if we do see this downward movement, what does that do for cap costs? Because that seems to be, I mean, it seems like every week I'm getting an article about these cap costs are causing anybody with floating rate to really have an issue, right? Because they're having to do escrows, they're having to buy a new cap. Have cap costs moved enough yet?
Not not a lot yet, but it's coming.
Okay.
Um, so I think we're probably 30 to 40% down from the peak of sort of early March, leading up
Yeah.
through SVB. So we're down quite a bit. I think what you're going to need to see before the bottom really falls out is the Fed actually does not hike it on June 14th. If they don't hike June 14th, that's when I think we'll have meaningful movement lower in interest rate cap pricing. The escrows, it kind of depends when that snapshot gets taken. They recalculate those twice a year.
Right.
So you might have just had one calculated, let's say mid-March. You've got a ways to go. You're not going to benefit until the fall. But there's no doubt cap prices will be lower 6 months from now than they are today. Like that's definitely on the horizon now. I think the peak is behind us. We're moving in the right direction, and this time next year, I suspect cap prices will be substantially lower.
Okay, so someone sent in this question beforehand. I'll just throw it up there, but I think I know the answer. I guess for people watching, feel free to put in the comments what questions you have. But this question came in. All right, they've got till August, right? So they're on the clock. They need to buy a new one, 2.5% strike. When should I buy it? Right, and I'll let you take that one.
So there's a lot of different variables that go into that, but all else being equal, I would probably wait, um,
Okay.
especially if you're just buying a 1 year. We've got some clients in this market who are taking advantage of the downward sloping forward curve and saying, you know what, let's go ahead and buy a 3 year today because years 2 and 3 are so much less expensive than they were 6 months ago. And
Okay.
we get to amortize those escrows over 36 months instead of 12. Um, but all else being equal, if your question is essentially, I need to buy a 1 year either today or in August, I think the better bet is you wait as long as you can.
So I think you answered this better than I even thought you were going to answer it. So you're saying that people, in order to get rid of their escrows, let's say on a floater, they're just going ahead and buying the 3-year cap now, potentially,
The
just to
replacement
get
cap.
the replacement
Yep.
cap. Okay, and
It
then
doesn't get rid of the escrows,
but it
but it means
reduces it.
that you take
Yeah.
that replacement cap cost and you escrow for it over 36 months instead of 12 months.
I gotcha. I gotcha. Because they were the Fannie and Freddie, they were calculating based off of, okay, you need to buy it and you've got 12 months to make that money up. But if you just go ahead and buy the 3 year, you might have a better pathway there. Okay,
Yep.
I gotcha. All right. So I went back through, so you came out in March to speak to us here in Dallas, and I went through some of that, and I just one of the things that we talked about was the discount window. And so is that back to normal, or are people still at the window borrowing? And maybe explain that to
Yeah.
people out there, what the Fed sort of set up when
Yep.
sort of the first bank went down, and I think over the weekend another bank went down, and it
There's
goes
another
back
one
to
today.
just going back to the fire of this is fine.
Yeah, exactly. So after SVB collapsed, one of the aggressive intervention measures by the Fed was they opened up this discount window, which essentially said, if you want to borrow cash from us, you can post those treasuries to us. We will give you face value for them. We won't discount them. We won't even say what they're worth in the market today. We're just going to give you par value for those with cash. So you post 100 million in par value treasuries to us, we'll give you 100 million in cash, right? Basically to shore up liquidity, try to stop a run on the bank. That window was opened and immediately had $350 billion drawn down on it. And they don't have to report the banks who are borrowing that window for 2 years. So 2 years from now, we'll know which banks were asking for the $350 billion. And the intent there is presumably don't send a signal about who the weak banks are. So we don't go out and continue to short those banks. That window improved, and it's kind of ticked back up again over the last week. Yesterday in Powell's press conference, he even referenced that it had dropped down but gone back up. So I think we're going to continue to see some fluctuations in that. I think if I have a question for the Fed, it's if you keep describing the banking system as sound and resilient, every opportunity you get, why does the discount window need to be open? If that's true, can't we close it and say, everybody go back to work? We survived the initial shock. We did what we had to do. Go back to work now. And that's not what they're doing. So it just makes it raises a question. What is it like behind scenes? What are they seeing something that we're not seeing that's causing them pause before saying, let's cut off the emergency measures and back to business as usual?
And like I guess it really goes down to, and I saw, so Walker and Dunlap did their earnings report, and they were just like, there is a hole of, and I could pull it up. I mean, there was some huge number, like $4.5 trillion that needs to get refinanced, and there's like 30% of that coming from banks, and so are other people going to step up and take that that uh that debt that's outstanding out there? I mean, what's your feel? Are we going to keep seeing banks slide and then get eaten up by JP Morgans of the world, and those guys? I mean, who knows what deal was cut behind closed doors, but
Right.
basically, like, you need to take this deal for us, because the FDIC can't take that amount of deposit failure, I guess. What do you Going back to your days, what's different from your days back 08, 09 to today? Or is it the same stuff?
I think the difference is that the government is not messing around with interventions the way that they did in '08. There was a lot of chatter about moral hazard of bailing out banks in '08. And I was friends with a guy who was at the Atlanta Fed at the time. And he told me a story about how he was in the room with Tim Geithner when they had this giant conference room, and the entire wall was like a chalkboard, and they were writing out the names of the banks, and they were basically ad hoc deciding which banks had to be bailed out and which could be allowed to fail, right? And so I was at Wachovia. We were one of the ones allowed to go under, and I think we were the last one that went under. And they just said, you know what, we're done. We're not worried about moral hazard. We need to just stop the contagion right now. So I think the measures you've seen this time around, because we've had 3 of the 4 biggest bank failures in history have occurred in the last 2 months, and weird time for the Fed to be describing the banking system as sound and resilient. But I think the difference is the Fed is like, we're absolutely not going to let that happen. We're not going to have the banking system implode the way it did in '08. I don't think the Fed likes the fact that JP Morgan is buying up a smaller bank and just adding to the too big to fail list. But I also think they have limitations. The Fed is still constrained by law and can only do so much to steer a deal a certain direction. If JP Morgan is the best bidder, they're not allowed to say, sorry, JP Morgan, you're not allowed to do this. This needs to go to another bank so we don't just keep adding to your massive size. So I think that's the biggest difference. And I bet behind closed doors, Powell wishes somebody else had bought up First Republic instead of J.P. Morgan.
Yeah, but I mean, it just everyone feels safe now because they know that everyone that they're not going to let J.P. Morgan fail, right? That's
Right.
where all the money's going into. So I guess for people out there, I mean, it's this here. Let me pull up the chart that they referenced in the pitch, and like it was. I don't know if you can see that, but I mean, it was like this 4.5 trillion of debt out there, and then if the banks don't come in, if this goes away, right, in terms of lending, I mean, what are you seeing from smaller sort of local regional banks? Are they doing anything right now, or what are you seeing on that side?
We're seeing it's very quiet on that side. And if anything, what we're hearing more and more of is what I would describe as almost like private lenders coming to the market who are well capitalized, saying, hey, this is an opportunity. We're going to get spreads that we would not normally otherwise get. We can get leverage that we would not normally otherwise get. And let's use this as an opportunity to make money in a new avenue for ourselves. But from the regional banks, even the strong ones, like we're not seeing their names on term sheets. I think the the orders have been passed down from on high. Hey, we're gonna hold off a little bit and just see how this goes.
Right. Okay. All right. So I guess the other piece, I mean, multifamily, which is what we do a lot of, is Fannie and Freddie, and almost everything lives and dies by the 10-year Treasury. What's the what's the 10-year Treasury doing? What's sort of the has this? I mean, it moved down a little bit, but it's still. I
Mhm.
feel like it's been in that sort of 3.25, 3.5 range for a while now, and
Yeah.
just sort of bounced up and down. At what point does it sort of break that 325 and just like get back to 2.5 or 2%?
I think we probably need to see more evidence of a significant downturn. So right now, things like the jobs report, like we get one tomorrow, are probably too strong for the market to like throw in the towel and say the 10-year needs to go to 2.5. Um, I think if we continue to see that weaken or soften, if we continue to see GDP come down, like last 5 quarters, GDP is 0.9%. It's pretty anemic, right? Like we're setting the stage for a pretty slow second half of the year and probably a slow start to next year. But we're getting pockets of strength that are preventing the rug getting yanked out from the market. Once those go away, which is presumably going to happen in the next 3 to 6 months, that's when I think you'll see that sort of catalyst that allows you to break through that floor. Because right now the range is the technical range. If you're like a 10-year Treasury trader, is extremely strong, sort of 332 to 390. It's going to take something to break one of those, um, and we're just not seeing anything that's that strong to do that yet.
All right, yeah. So here's the 10-year Treasury. I pulled up this. I'm not a technical trader, but the what you're saying. All right, so here's sort of 10-year today, and you're saying sort of that 325 to 4. That's once
Yep,
we break through that, then all hell is gonna break loose, and
that's right.
and we're gonna.
So until the market feels so pessimistic that the recession is imminent, it's going to be tough to break through this bottom end. I think the top end is off the table. I don't see us breaking that anytime this cycle. But the bottom end has been holding up, and I think it'll keep holding up until we get like if we have a really disastrous job report tomorrow, like shockingly bad. That's when you'll see us break through. If it comes out and we've added 180,000 jobs, the market's going to say, you know what, labor market is still strong enough that the bottom's not falling out.
Okay. And I guess and you had mentioned this earlier, I think on one of your newsletters, is around just sort of real rates.
Hmm.
And I think he addressed that a little bit
They
yesterday
did.
during the
Yep.
meeting, right? So are we there from his perspective? Are we there? Are we close enough?
Yeah, that was probably one of the things that he said that went pretty unnoticed by most people, but I thought was one of the main takeaways, which is um, their entire philosophy during this tightening cycle has been we need real rates to be positive, right? We need where we set rates to be higher than inflation, and it hasn't been. And so now we're sort of transitioning. And the question is, and they won't ever quantify this exactly, like how positive do rates need to be in order for the Fed to view it as sufficiently restrictive? I've been ballparking that number at around 1.5%. I'm just speculating where I think that is a reasonable number. Yesterday in the press conference, he said there's a lot of different ways to measure this, which is true, which is why it's a little challenging to do. But then the example he used was real rates are at 2%, which everyone would agree is very restrictive. You know,
Okay.
it is rates are very tight right now. To me, that was a signal that we're comfortable with where rates are now. We can stop here because they are sufficiently restrictive. And now we need to focus on time at these levels rather than the peak. You said how he just kept beating a dead horse about we've hiked 5% in a year. We've hiked 5% in a year. It's like, exactly. One more hike is not going to suddenly win the war on inflation if the first 5% didn't, right? So let's stop obsessing over whether there's 25 basis points more to come and instead say, how long are we going to be here? Are we going to be here for 3 months, 6 months, a year? Because I think that's really what they're focused on going forward.
So your chart probably a year ago showing the time between the last hike and the first cut on average is magical 8.7 months.
Yep.
Um, what? They're officially not on the clock until the next meeting, right? So they've got to pause, and then is that when the clock starts?
No, it'll start to yesterday if they don't
Okay.
hike at the next meeting.
Okay. Okay. All right. It starts May 3rd, and then they're on the clock. But the market has them cutting already. I mean,
Yeah.
does something have to break for them to cut that fast? Or are they just going to hold here for as long as they can possibly hold?
Yeah, so I'm in a dangerous position here because I disagree with the market on this one, which is never a good place to be. But I think that the other graph that we have in there is that if the average is 9 months, the fastest ever is 5 months.
Okay.
So if for them to start cutting in July would be borderline unprecedented. And so I just don't see that happening. I think now if something breaks, if there's financial instability, all bets are off. But just because we get a couple bad job reports, to me, doesn't mean they're going to start cutting. I think they're going to say, doesn't matter. It's about inflation. They have already called for 1.5 million Americans to lose their job between now and year end. That's 170,000 jobs lost per month between now and year end, assuming we start tomorrow. So they're already expecting quite a bit of pain without a corresponding drop in rates. So I think the market is overly optimistic that they're going to be cutting rates this year. And we're probably going to see them hang on for dear life through year end, and then they're going to start cutting.
All right. So here's the graph that you guys presented. So on average, the 8.7 months. So you're thinking they're gonna hold on as long as they can, and the market is just a little bit too optimistic on when it cuts. So, but in terms of pricing, you guys had it, I believe, at the cap cost here. Maybe touch on the cap cost because I mean this is what people
Mm-hmm.
are sort of their negative cash flow, and a lot of people right now. Obviously, we're seeing this gap between buyers and sellers. On the seller doesn't want to go right now,
Yep.
right? And they're saying, how long do I have to hold this asset before? Because I can only feed this thing for so long,
Yep.
right? So, talk about the cap cost and timing on when it actually goes.
So we went back and reviewed last several tightening cycles, and we found that usually within 3 months, cap prices had dropped 50% after the last hike. So you're talking about this summer, cap prices could be down substantially. And that's a result of two things. Cap prices are driven by two primary factors. Number one is rate expectations. You think about the forward curve, just what do we think rates are going? And once you get on the other side of a pause, the market just knows the next move is a cut. So it starts pricing in downward expectations. And so caps become less expensive because the market thinks rates are going down. The other component, and this has been killing people over the last 12 months, is volatility. And volatility is just sort of uncertainty. I mean, imagine if you're an option trader trying to sell a cap to somebody over the last 12 months. November 2021, the Fed said they were not hiking at all last year. They then proceeded to hike 5% in 12 months. If you're an option trader and you're selling that to someone, how do you charge them appropriately for that? And so they're just charging an arm and a leg saying, I don't think we're getting to 6 or 7%, but I didn't think we were getting to five either. And so I got to charge you something just in case. Once the Fed pauses, you can take that upside scenario off the table. You can take 6% off the table and say, you know what? We're not getting any higher than 5.25. I can price that appropriately. And so the volatility component of a cap gets sucked out of it. And now it's really just more about the difference between expectations and where your strike is. And it becomes a much more efficiently priced hedge. And that's part of the reason why you see cap prices drop so much. So I suspect we'll see a lot of relief in cap pricing in the next 3 months.
So do people go back to team float?
um,
After what we just went through, if it's just sitting up there and cap costs aren't that expensive, right? So maybe it's 1% of the loan amount instead of 4 or 5% of the loan
mhm.
amount for 3 years. Do I just go back on a floater?
I've been surprised that more people haven't gone fixed. So I'm not sure that people have ever left Team Float. um, I think I think we tend to think of it in just terms of interest expense, but from a borrower's perspective, they're frequently looking at things like flexibility, and that comes with a price sometimes. And this past year, that price has been probably the highest they've ever paid. But they still like that flexibility better than they like, let's say, a yield maintenance or a defeasance penalty that might be stretched out over, 6 or 7 years of a remaining term. And so we have done a lot of analysis for people who have contemplated going to fixed, but we haven't seen a ton of people actually convert to fixed. So I think there's probably a lot of team float people out there who are just like, can we please just end this tightening cycle so I can start to think about the backside of this curve?
Yeah. So I appreciate you coming on. We still have like 30 people on. So if anyone has any questions live for JP, this is your chance to chime in with your questions. I'm trying to think if there's anything else that people sent in beforehand. Um, what is something that people are not watching but they should be watching right now?
Probably the debt ceiling debate. It's
He said don't worry about the debt
which is why I'm worried about it. Um,
ceiling.
I think the Fed is basically saying we have no way to possibly factor that into anything that we're doing. If the U.S. defaults on its debt, all bets are off. Like I just don't know what's going to happen. So this is going to be a big deal in June. And has the potential to have a huge impact on the economy. And the dollar is a reserve currency should we default. So I think it's an incredibly low probability event, but the sort of thing that would be catastrophic if it occurs. So I kind of feel like Pal does. I'm like I can't plan for it, and I just really really hope it doesn't happen.
But if that happened, what would the Fed do? Like, would they cut rates back to zero, or do they have to raise rates? I don't even know
Yeah.
what happens in that scenario.
So they don't know because it's never happened before, right?
Right.
So we don't know what they would do. It'd probably depend on what happens to financial stability more so than anything else. Um, does liquidity dry up instantly? Right. If it does, they'll jump in to try to provide that liquidity. But I don't think there's an easy answer of if this happens, then they will do this because we just don't know. I mean, I still remember when the United States got downgraded. I think it was 2011, and I thought treasury yields were going to spike. Right. And I thought, oh my gosh, they're going to run away from us. We're going to be up a point tomorrow morning, and they were down. And it was because the market said, well, if the U.S. is in bad shape, everyone else must be worse.
Right.
And
So we'll
so,
take the U.S. Treasury.
right, the U.S. is still better than everybody else, and now I'm really worried about everybody else. So, yeah, it's just one of those things that's out there as a risk that hopefully does not come to pass, but the ramifications could be enormous if it does.
Well, JP, either my chat is not working or people are scared to ask you any more questions. Well, I'm gonna cut it off right there. I appreciate you jumping on, giving us the latest from this last meeting. And if anyone wants to reach out to you, what's the best way for them to reach out to you? Is it Pensford? Is it Loan Boss? What's the best way?
Yeah, just go to the Pensford website, and there's a contact us button on there that'll get connected to us.
Okay. All right. Thanks a lot, JP.
Thanks. See you guys.
All right. See you. Bye.